JJ Bell, for inviting me today. So I'm going to talk a bit about the global economy, and then I'll focus in on the UK. And my role at Schroders, as well as being chief economist, is I sit on the asset allocation committee. So a lot of the slides I use in this presentation will actually be slides that we use in the asset allocation committee. And I want to start off really by talking about some of the macro forces that are actually shaping the world economy at the moment. And I think it's always very useful just to stand back and see how the different economies have fared since the global financial crisis started. So this is a chart of output of real GDP in a series of major economies. And you can see immediately that the US economy has been the best performing. So in many ways, maybe it's not so surprising that the US economy has been one of the best, or the US market has been one of the best performing of the equity markets since the crisis. Not far behind is Germany, which surprises a lot of people because they think of Europe and the Eurozone and think of that being a real problem, but the German economy has done pretty well, thank you. And then just coming up on the rails there, you'll see the UK. And until about 2 years ago, it looked as though the UK wasn't going to grow again. You know, we were really very, very flat. And then things really began to take off, and I can say a little bit about the reasons behind that. But let's just round up on this. If you go further down, you'll see the Eurozone aggregate. The Eurozone is only just getting back to where it was before the crisis. Japan had done quite well. Then, of course, they made the mistake they made back in 1997. They raised the consumption tax. The economy went back into recession again, and they've gone right back. And then right at the bottom there, you can see two of the peripheral economies of the Eurozone, Spain and Italy, and quite a divergence. Spain, in many ways, has been the kind of poster child of the Eurozone restructuring efforts, and they've done all the things that Germany has told them to do, and finally they are actually getting some growth. Unfortunately, they are about 6% below where they started, but you know, they are kind of heading in the right direction. In contrast, Italy is actually still in recession, some 6 or 7 years later, so a little bit of a worry there. The UK recovery, you know, we tried and tried. We wanted to rebalance our economy. We wanted to have export-led growth, but when your major trading partner is in recession, that's very difficult. So our recovery has actually been like so many UK recoveries. It's been driven by the consumer and the housing market. And one of the consequences of that, which I'll come to later, is that we actually have quite a dodgy trade position. Nonetheless, it is a good performance, and George Osborne is right when he says we were the strongest growing G7 economy last year. So that's fine. We're probably not the best performing over a longer period of time, and certainly there are big questions about productivity growth in the UK, but the economy actually is doing pretty well. Let me just broaden out the discussion, because obviously as international investors, we've got to think about the emerging markets as well as the developed. And you know, one of the big stories of the last few years has really been the disappointment of the emerging markets. Very often, if you were an investor and you thought that things were going to get better in the world economy, you would buy the emerging markets. Well, that hasn't worked this time. And you know, why is that? Well, this slide gives you a bit of a clue as to something that's gone wrong. These two indicators are really activity indicators. They're called the Purchasing Managers' Indices. I'm sure you've heard of them. If they're above 50, it means your economy is growing, basically. And you can see that we've had quite a bit of recovery in the developed world. The blue line has been positive, but the orange line, which is the emerging markets, has really gone absolutely nowhere. That's one of the reasons why emerging markets have underperformed by so much. If we drill into that and think about, you know, that acronym, the BRICS, which was Brazil, Russia, India, and China, you can immediately get an idea of why things have gone wrong. You know, first of all, China has struggled. Growth maybe 7%. People say, oh, that's fantastic. It's stronger than anywhere else. But actually 7% is not that great for an economy at the stage of development that China's at. And also 7% might not actually be the real number, because it's just mysterious how it always manages to hit the growth target that has been set by the government. Look at B and look at Brazil, and you've got real problems there. You've got stagflation. You've got interest rates of about 13.5% at the moment. You've got an economy that's not growing. You've got a corruption scandal that seems to have reached just about everybody in Brazil over Petrobras. So there's real problems there. And then look at R and look at Russia. You know, Russia is in danger of being excluded from the world economy if it carries on with its activities in Ukraine. Probably the best place is India, which of course has done pretty well, and it's got good economic management. But I think it does bear out a point that if you are going to invest in emerging markets, do choose an active manager, because there is so much to choose from, and the divergence between these different economies is huge. And in many ways, BRICS is a totally misleading investment concept, because these economies don't have much in common. What about the outlook at the moment for the world economy? That gives you a snapshot of where we've got to. What about the outlook? Well, I'm actually quite positive, and I think that the fall in the oil price is a real positive for the world economy. It's not something that's really coming through in the data as much as we would have hoped for at the moment. But what I'm just showing you here is just a couple of measures of the Brent crude price and the WTI price. So crude oil price, you can see how it's fallen very, very sharply through the second half of last year. As an economist, when the oil price falls, you've got to identify whether that fall in the oil price is because of a collapse in demand in the world economy or because of an increase in supply of the oil. If it's because of a collapse in demand, you've got to be worried about it, because it means that something is going wrong. And all the oil price is doing is it's acting as a barometer. And it's maybe going to cushion you a little bit, but it tells you there's something wrong with the world economy. That was really what was happening in the financial crisis, if you see that massive fall off in that grey shaded area. But the recent fall actually has been much more due to supply-side factors. It's due to Saudi Arabia deciding that it didn't want to be the swing producer anymore. It didn't want to be the one that always had to cut production to support the oil price. So this, for my money, is saying that this is a positive shock, because it means that we've actually got more oil coming on, and that's going to help the world economy. It's not because demand has collapsed. There are some demand problems in the world, but when you have the biggest producer in the world increasing production, or certainly the lowest cost producer, that's a very good signal. So I think that's going to help a great deal. I'm going to skip over this one, because I just want to focus a bit on this slide, which is really the culmination of looking at what happens when the oil price falls, running it through a model of the world economy that tries to take account of consumption, investment, the costs of doing business, and works out what it means for growth. So this is using an econometric model that's constructed by a group called Oxford Economics that we subscribe to. And so what we did is we cut the oil price just by 10%, and we said, well, what happens to these economies if you cut the oil price in that way? And we found that all of them got stronger growth after 1 year, 2 year, and 5 year. This is the effect on GDP. And you can see that US, Japan, China, Eurozone, and the UK all did better. And in the kind of world we're in at the moment, where people are concerned about growth and they're concerned about corporate earnings, to have something that can act like a tax cut effectively to boost consumption, that people can spend the extra money that they save, that they would have spent on filling up their car or heating their house, they can spend that on consumer goods and can boost growth. That's going to be good for the economy, and it's good for equities, because equities, of course, very closely linked in to the economic cycle. So, this is sort of one of the main macro reasons why we remain positive on equities in our very broad asset allocation. So oil is a really important factor in shaping growth, and so when we're investing, we're looking quite closely from the macro perspective at which economies are going to benefit the most. And so we use that kind of analysis that I've just showed you. The other factor that is very important is currency, and you may well be aware of this term, the currency wars. If you're in a world where growth is limited, how do you get more of that growth? Well, if the pie is not growing as fast as it did before, the best way to get a bigger share of the pie is to become more competitive. And what's the easiest way to become more competitive? Well, you devalue your exchange rate. That's exactly what you have to do. And that's really what the currency wars are all about. So we monitor the exchange rates very closely as to where they've got to, and we look at them relative to their history, and we create these kind of charts, these box and whisker diagrams, which kind of show you the range of currency movements for different currencies over the last 10 years. And what you see from this very clearly that the US dollar, which is on the left-hand panel there on the right-hand side, the US dollar is trading right at the top now of its 10-year range. About a year ago, it was kind of in the middle of its range, but it's now become quite expensive. And the counterpart to that is that the euro, and to some extent the yen, are trading in the lower part of their range. So when I'm thinking about the world economy, and I'm thinking about where is the growth going to go to, who are the companies that are going to grab market share in this environment? Well, those companies are in Europe and Japan. That's where you want to be skewing your portfolio towards. Now, the US has some great companies, and they have a lot of strong market share, and the US market has been one that we've actually liked a lot for the last 3 years. But over the last few months, we've been beginning to rotate out the US and been going into the Eurozone and into Japan. And I think those are the areas that will deliver the earnings growth because they've got the competitive advantage. And I think that competitive advantage is going to stay in place for some time because the US economy, as we showed you earlier, is leading the recovery. The Federal Reserve is recognized that it's going to have to start raising interest rates. The US economy is getting back to normal. It needs to have a more normal level of interest rates. Whereas in the Eurozone and Japan, they're still doing QE. Interest rates are 0. They're actually slightly negative in the euro area. So those currency movements are probably going to stay in place for some time, and that's going to keep the support going, I think, for Europe and for Japan. You'll notice that there's not really much of a story on the GBP at the moment. We're right in the middle of our range, and I'll say a little bit about the pound in a moment when I talk about elections. If you look on the right-hand side of the panel, I won't spend too much time on that, but just highlight two. China is very expensive, but China tracks the US dollar. That's why it's expensive. But that's one of the problems for the Chinese economy. They're an export-orientated economy with an expensive currency. That's not a good combination for growth. Cheapest currency? Well, it's the Russian ruble. Well, there are good reasons sometimes why currencies are cheap. Okay, so those are the kind of things that we discuss in our asset allocation committee when we're thinking about where to move our assets. So, as you probably gather, we're positive on equities. We have liked the US, but we've been pushing money into Europe and into Japan. We're still not that keen on emerging markets. We're looking for some of those indicators that we've got to begin to improve. So what about the UK? Where does the UK sit in this? Well, the UK market is not that attractive at the moment. Political uncertainty is clearly a factor. Let me say a little bit about the election. I can't really add very much. I'm afraid I can't tell you who's going to win. I don't think anybody can. This is a chart showing the Conservative against Labour and in the opinion polls. And you can see that, for most of the last few years, Conservatives have been behind. They've been gradually closing the gap. They certainly need to close the gap because the way that our system works is that Conservatives actually have to have a lead in the opinion polls to actually get a lead in Parliament because of the way the seats are distributed. It did look as though there was a trend building, because if you think about that first slide I showed you, the line looks a little bit like UK GDP. It was very flat, and then the economy began to recover, and it began to improve. So improving economy, improving votes for Conservatives. But unfortunately for David Cameron and co, it kind of stalled out. And I think it's one of the great sort of mysteries, actually, as to why the Conservatives aren't doing better when they've managed to get unemployment down considerably and they've managed to reduce inflation. Normally, those two factors alone will determine the election. I think it could be something to do with the fact that real incomes have not really risen very much, so people don't feel better. But I'm sure somebody will do a PhD on this at some point and find the real answer. So it isn't working in the same way. Another factor, of course, is that there is the big rise of what you could call the third parties. And it does make the arithmetic extremely difficult. This I took this from the FT website last week, and very useful. They're still useful. They're still updating this, and it sort of tells you how many seats you'll get from the poll of polls. So, when I did this, it was the Conservatives were going to get, I think, 286, which would be quite a good outturn for them. Still down by 20 odd. Labour will get 267. But when you look at the plausible combinations of coalitions, the first three are still Labour, because Labour could get the support of the SNP. So it could be one of those elections where the largest party doesn't actually end up forming the government. You've got to go back to 1924 for the last time that happened, but it is quite possible. So huge uncertainty as to how things will turn out. And from a macroeconomic point of view, that's not great for growth. People will delay decisions if there is uncertainty in the economy. You will not necessarily go out and buy that bigger house, or if you're running a business, necessarily make that investment if you don't know what the tax code is going to be, if you don't know whether there's going to be a mansion tax or what have you. It might only be a temporary delay, but it can be enough to cause the economy to weaken quite substantially. And then what about the balances in the economy? I referred to this earlier. I talked about the UK recovery, and I said how it'd been very consumer-driven. And of course, the downside of that is that we sucked in quite a lot of imports, and our current account deficit is now running at about 5.5% of GDP. So that is a bit of a problem, because it means that we have to attract capital into the UK every month, every year, in order to offset the amount of money that's flowing out in order for us to buy goods and services. So, that represents a capital flow that we need to pull in. Now, we've been able to pull it in quite easily for most of the time. The pound has been reasonably stable over the last 2 or 3 years, partly because interest rates everywhere else are so low. So it doesn't really matter that our economy might not be booming. But political uncertainty can undermine that, and it could mean that investors think, well, I really like the UK because it's such a politically stable place, very transparent and so on, but, if there's going to be a period now where we don't know who's going to be in charge, then maybe I won't buy the pound, I'll cut back, I'll go underweight on that, and that could lead to some weakness. What's the source of the current account deficit? Well, you can break this down, and you have to look at this chart in quite a lot of detail, but I'll just quickly explain what it means. Basically, it's because the government is still borrowing quite a lot. Despite all the efforts at austerity, we're still borrowing about 5% of GDP. That's our budget deficit. And the problem is that means that if we want to improve our current account deficit and get a recovery in the economy, we have to reduce our budget deficit. And that's why austerity is still going to be on the agenda. And if you look at the plans of the different parties, the one thing they do have in common is that they do believe in austerity. Even the SNP, who've claimed they want to end austerity, their profile of borrowing is for a steady reduction. So these charts on the left-hand side, this is just showing you the budget deficit and how it's going to be falling very nicely over the next few years. Whoever gets into power, if you want to get into a surplus, you vote Conservative. If you want to have a budget deficit of about 1%, you vote for somebody else. The Institute for Fiscal Studies analysed this, and they found that although these intentions were very noble, nobody actually said how they were going to achieve this. The Liberal Democrats claim that they would find £9 billion worth of savings over the next Parliament as a result of tax evasion. IFS asked, well, they've been in power for 5 years, how come they managed to miss this £9 billion, which is obviously lying around somewhere in the Treasury? Labour had some spending cuts that actually would raise nothing at all, as the IFS said. One of their spending cuts was not to upgrade child benefit. Well, there aren't any plans to upgrade child benefit, so that will raise precisely zero. And I could go on. So it's all pretty doubtful. Of course, the Tories have got this big £12 billion they're supposed to be cutting from welfare without any idea of how that's going to be done. So we will find out, obviously, after the election. I guess the only sensible thing I could say is that probably under the Tories you get a slightly tighter fiscal policy. I don't think it's going to make a huge amount of difference either way. They're just not telling us what they're going to do. What about investment and the markets? Well, we had a great presentation earlier about that. I think the only thing I can add to it is to say that this election is a bit different in that we really don't know what the result is going to be, and we're almost at polling day, and that's quite unusual that you can say that. Where are the markets reacting to this? Well, the things to watch out for, obviously the pound. I think the pound is really the lightning rod, the conductor for political sentiment in this environment, particularly given our current account deficit. The gilt market, you can look at the spread between gilts and treasuries and calculate all kind of risk premiums and what have you, but it's not really telling you very much at the moment. The FTSE, I think there's a bit of political risk in there. Although the FTSE is 7,000 and everybody's saying, oh, that's fantastic, what a great performance. It's actually not really that good on a global scale. FTSE's been underperforming for quite a while. It's partly because we've got a lot of companies that people don't like at the moment, because the UK index is unfortunately a bit like an emerging market index. Got lots of commodities in there. Nobody wants those. But, if Labour get in, energy, some of the sectors, some of the water, things like that, could get regulated more heavily, so they'll get affected. So there has been underperformance there. So I watch the FTSE and I watch the pound. Those are the two things that are going to react on Friday. I'm out of time now, but thank you very much. And I think we're going to have a few Q&A, so thank you.